Good morning, everyone. Welcome to Coffee with Carl. Today, I have the esteemed pleasure of having Zach Hill with Horizon Investments. His firm oversees north of $6 billion. He's a global macro strategist. And welcome, Zach.
Good morning. Thank you for having me, Carl.
Yeah, my pleasure. Today, kind of lead in like I do a lot of these other conversations, just dive right into the markets. Over the last month or so, and in the last year, we've seen pretty substantial gains from the big hit that we saw last March. And a lot of the concern now has been really on the valuation side. A lot of people are comparing this to the dot-com bubble with the Nasdaq in 2000. How do you see that as, what parallels do you guys see on that end? Because some of the concerns I'm hearing is when you start to talk about some of the special interest companies and a lot of these companies going to IPO and marijuana companies all are going parabolic. Do you guys have any concerns? And, where do you guys see the markets now?
There's certainly parts of the market that are exhibiting some exuberant behavior, I would say. But when we look at valuations, it's not something that's really that easy to do on a time series or absolute basis. For us, it's much more of a tool that we use cross-sectionally. So we're looking at relative valuations of different parts of the market to each other. And on that scope, if you're looking at some parts of the U.S. technology market, for instance, compared to European financials or something, absolutely, there's a very, very wide valuation gap. But just at a broad market level, while there's definitely some pockets of froth, we think a lot of that has to do with just people being bored at home with nothing else to do, and not some sort of systemic, big market-wide event that is, flashing warning signs to everyone.
Yeah, I mean, when you speak about, valuations and opportunity, I guess more so on that end, how do you guys look at the technology space? I mean, it's been, one of the biggest drivers of the market. Does that space in general, has it started to provide some concern for you guys?
Not really. I mean, we have been, big proponents and big holders in U.S. technology names. They've been both, very well rewarded by the market with high multiples, but also they're really able to generate a tremendous amount of cash in really any kind of environment. And in terms of our various strategies and the kind of the way that we look at money, managing money, that's been something that over the course of the last, call it year, we've been steadily kind of decreasing our tilts towards technology, just as a reflection of some investor crowding and that kind of relative valuation gap that you're talking about, Carl.
Where are you guys? Where are some of the areas of opportunity that you guys have seen and started to shift to?
Absolutely. So I think it really November of last year was a really, really big event in markets. All of 2020 was really about COVID, about how companies can manage through that, how economies can manage through that, and you had a lot of fits and starts of reopenings and optimism and everything else. But in the end, they all kind of proved to be flashes in the pan. What we had in November, first of all, the passing of the just kind of the general concerns around the U.S. election with a result that was not contested and that type of thing, and generally viewed as relatively investor friendly. In the end of the day, that's just something that supported risk appetite as some risk was taken out of the market. But really, the Pfizer news that came the week after, and then the Moderna news, on the vaccines was just much, much better than anyone anticipated. And what that allowed market participants to do is to start to think about actually acting upon that valuation anchor you're talking about. It's all well and good to say that, this particular sector of the market or these types of companies are cheap, these ones are really expensive. But when you don't know how long the current situation is going to last economically, it's really hard to lean against that type of an argument to actually commit capital. And so, by crystallizing somewhat of a time frame in investors' minds, that kind of November event around the vaccines really kind of changed things. Mm-hmm. And so what we did, in terms of our portfolios, kind of the way that we looked at that and what we saw as the best kind of risk reward within the framework of what we tend to allocate towards, it was twofold. One was smaller cap U.S. shares, and the other one was emerging markets, specifically Asia, but emerging markets broadly speaking. Those are two major tilts that we've had in a lot of our allocation portfolios, and ones that we've continued to add to over the last few months.
Okay, great. Yeah, I mean, there's been a lot of talk about opportunity in the small cap space as well as the emerging markets. When you think small cap, where are you guys more tilted towards the growth side of the house or value, and how are you guys thinking about that tilt and your overall balance when it comes to that?
I'd say we're relatively balanced on the small cap side. I think we have a little bit more differentiation on the emerging market side, but in terms of small caps, I think we just generally speaking, there are a couple of reasons that we like them. For one, they're the most geared towards economic growth out there. They're the smallest companies with the highest, leverage to general economic growth, and they're also the most fragile. So when conditions are bad, they are the ones going to get hurt the most, and we saw that in spades. Both in in 2019 through the trade war, and then in early 2020. And so that's something, as that starts to change, they will get re-rated by investors, their fundamentals will improve, and that's just something that we think will continue to happen from here. The other reason that we like small caps, maybe over some other sectors of the markets, is that we've kind of noticed that there's been a massive increase in corporate liquidity. Everybody issued a ton of debt. 2020 was a record year for corporate issuance. They did it, generally speaking, as a preventative measure to have cash on hand just in case they needed it. Well, actually, it turns out that they didn't need it. They didn't need as much as they thought in April or May that they needed. And so that's cash is just sitting on the balance sheet without anything to do. Can't really invest it in short-term treasuries and earn any interest or anything like that. And so once we start to get some clarity around the economic outlook, we think there could be a potential a boom in M&A that would benefit, generally speaking, the companies that are acquired, which are going to be smaller cap shares. And so we think the market is kind of moving ahead of that to kind of price in some of that phenomenon.
Yeah, you talked about some of these smaller companies not needing the money. I mean, how do you think that's going to be reflected too when we print even further money with the potential stimulus bill that's coming down?
Look, there's a lot of stimulus out there. I mean, we're talking about another stimulus bill in the 1.5 to 1.9 trillion dollar range. It's almost amazing to actually say those words with a straight face, but here we are. But the fact of the matter is, a lot of the stimulus that we put in place last year on the fiscal side has not been spent. There's about 1.5 or so trillion in excess savings over the run rate that we would have had before from pre-pandemic times. The consumers have just not spent, and that's a function of two things. One, the very generous direct subsidies from the federal government to U.S. consumers, and two, the fact that our consumption opportunities have been generally curtailed. You can't spend money the way that you normally do on travel or restaurants or whatever else, and you can only buy so many goods to stuff in your house and put in your backyard. And so, we've basically, as a consumer in the aggregate, accumulated a lot of excess cash, and that's something that, as we start to reopen, sort of towards the summer and the back half of the year, we think there's a really good chance that excess cash is deployed in a pretty meaningful way.
And prior to this, we talked a little bit about kind of how you view the end of the year. It would be helpful if you could dive into how you're looking at the markets as we turn in the end of the year and people start to go back to work.
Sure. So, Carl, this has been, I think, probably one of the most persistent questions we've gotten over the last year is, how can the economy be so bad and the markets be so good? A lot of people have kind of answered this question in various different ways. But I think it should be pretty clear to everyone that they are not the same thing by any means. If you're looking at the S&P 500, that's the 500 biggest names. Almost half of that revenue is derived from overseas. That's not the companies that are down the corner from you on the, in your downtown or wherever else. And so there's just that fundamental disconnect in terms of the footprint of what you're talking about, the markets versus the economy. And the other thing I think that's potentially underappreciated, I talked a little bit about the fiscal stimulus. And so you're, sending out checks to people and people are not able to spend in the aggregate the money that they're typically used to spending. Well, it stands to reason that some of that money made its way into the equity market, especially as prices really started to rally significantly throughout last summer and into the fall. A lot of that, I think, was predicated on the really aggressive actions by the Fed in March of last year. And so I think kind of counterintuitively, we're very, very positive. First of all, for the kind of the first half of this year, we think there are a lot of really, really strong tailwinds to equity markets. But there's a potential in the second half when actually the economy starts to get a little better and we start to open up as a group and start to spend money elsewhere and not save, that the market could get a little bit rocky, in the second half of the year. So I think just how we had the disconnect in last year about the economy and markets, there's a potential, and not nearly as severe. Let's very much hope, but there's a potential for a kind of a reversal of that phenomenon in the back half of 2021.
I thought that was a really interesting point. Just from the standpoint, a lot of the talking heads and market analysts are talking about how strong the second half of the year is going to be because you're going to have insane growth on the from the GDP perspective. But I tend to find that really interesting when you're thinking about people actually having to go spend outside of their staying at home and being able to invest in the market, and that could potentially pull back some of the funds that are invested currently.
Yeah, one more point on that, Carl. Though, I do think that it does depend a little bit on what the Fed does in that situation. And so, a lot of market corrections generally happen because the Fed makes some sort of policy error. Think about the taper tantrum in 2013 or Q4 of 2018, something like that. And so, I think that's going to be the really thing that we're going to be paying a lot of attention to is communication around, what the Fed is doing. And so in the case where they're continuing to maintain accommodative policy like they have today, extraordinarily accommodative policy like they have today, that's a much better situation for the market where they're all of a sudden talking about hiking interest rates maybe in the following year or something like that. By no means our base case, but that's something that we're paying attention to pretty substantially as the year goes on.
Yeah, along that same point, if you guys were to pinpoint a couple of things that are really concerning to you, maybe not necessarily this year, but would you think more next year with the taxes, how or just corporate tax raises? What are there anything that you guys would pinpoint, and how would you guys model that type of correction in the market?
Yeah, so corporate taxes is absolutely a worry. I think it remains to be seen a little bit how much is potential. I think the Biden administration and the Democrats definitely do want to make some changes in this direction. But at the same time, kind of the mood music, so to speak, coming out of DC has not really been let's raise taxes and crush the recovery. It's been more like let's make sure this recovery is robust and self-sustaining after we're able to get through the public health concerns that we currently have today. And so I think we're not terribly concerned about it, but it's definitely something that we're thinking about. Putting the corporate tax rate back up to 28% or something like that is sort of what's been bandied about, was talked about in the campaign. Maybe it's not quite that high. If you want to kind of, the other side of the agenda that gets a lot of airtime is sort of the Build Back Better, kind of the strengthening the American economy from within in the corporate sector. And so one way, you can't do that through higher taxes that are going to make jobs here not competitive to places across the globe. And so that's something that we're definitely thinking about, and we're looking at it like on a sector by sector basis, and for the market as a whole. And it would definitely hurt earnings, but it would create some winners and losers too, depending on how it actually gets done. But really at this point, these are just ideas that haven't even really been floated in any kind of meaningful way. So it's in the back of our heads, and we're definitely thinking about it, but it's not kind of top of mind right now.
Yeah, I think one thing that started to become top of mind you hear in the news now is inflation. How are you guys, thinking about inflation? I imagine that's not a concern just yet, but it could certainly start to come into the picture. And then how do you guys think about that in the context of managing fixed income?
Yeah, absolutely. So, yeah, you're right. Inflation is on everybody's lips right now. You've seen kind of the moves that we've had in long end bond yields in the U.S., are kind of above the sort of key technical levels, 120 in the 10-year and 2.0 in the 30-year. These seem like really low yields, and they are, but relative to the last year, they're a good bit higher than they have been. And so, inflation is definitely a hotly disputed topic. we've studied this a lot, looked at a lot of historical parallels, and kind of the way that we've come down on the sort of inflation argument is that we don't really think anything fundamentally has changed from a medium term perspective around inflation because of COVID and the recovery. There certainly will be some very hot inflation prints coming up from base effects in May and June and throughout the summer, especially if we get to the point where the economy really reopens in a meaningful way and people start spending a lot of money on against a kind of a supply constrained market. But that's a temporary phenomenon. The Fed has voiced that that's a temporary phenomenon, and they're going to be looking through it. And I think generally speaking, that's what we should be doing as investors as well. So we're a little surprised with how quickly long end rates have backed up here in the first kind of 6 weeks of this year. But we're not in the camp that we're going to start to see the kind of bond yields that we've been used to for the last 10 or 15 years, call it 4 or 5% on a 10-year bond or something like that. And so I guess the second part of your question is, what does that lead to from a fixed income perspective? That definitely, it significantly challenges the 60-40 portfolio just at its kind of at its core construction. If rates can't go that much lower and starting yields are really, really low, well, the best predictor of what bonds are going to return is the starting yield. And so, it's pretty straightforward that things don't look very good on a 3 to 5 year basis looking forward for those kind of constructions. And so then what do we do about it? I think everybody kind of knows that that's the situation, but what do you actually do, with that 40% of your portfolio? And, I think this is where kind of Horizon's view as a goals-based asset manager that, we're looking at what the individual needs and what the individual, the money, but whatever pot of money should be doing for an individual for his goals or her goals, and not just some kind of across the board blanket solution for everybody. And so, it basically, the answer is it depends. If you're an earlier stage investor, you're starting to accumulate wealth, that means that your fixed income allocations need to incorporate other sort of higher risk areas of the fixed income market that maybe you haven't necessarily dabbled in, something outside of core bonds like emerging market bonds or preferred equities or something like that. And it's important when kind of looking at those things, they don't have the same the exact same profile as it's a kind of a conventional fixed income instrument. And so, you need to be looking at those types of investments in a tactical framework that has some sort of risk management capabilities built into it, because, fixed income allocations do still need to kind of behave somewhat defensively if equity markets are not going straight up as they are at the moment. And so, as you kind of, as investors kind of move out the wealth curve and the needs for their money changes, well, then it becomes a completely different situation. So take a retiree, for example. Plenty of people would like to just, clip the coupon on their bond fund and live off of that. And then, you got something left over at the end of the day, give it to your grandkids or something like that. That's just not feasible for really anybody at this time. And so, we've kind of recognized this and have been building strategies to support retirement spending for the 20 or 30 or longer years that a retirement problem is these days because of how much longer people are living. You do that in a couple different ways. You make sure that you have kind of a tilt towards the equity markets in more of a total return fashion rather than just an income-based fashion. But at the same time, that introduces all sorts of new risks that you need to make sure that you're taking account of, like sequence of return and things like that. And so, I think it really depends on where an investor is along the kind of the wealth journey in terms of how you need to be thinking about fixed income. But make no mistake, like everybody across the spectrum needs to be rethinking sort of how they're using fixed income.
Are you still comfortable in the high yield space? It seems you're starting to see some companies take a little more risk to generate those returns from the different managers. Do you guys still feel comfortable there?
Comfortable, not really. I mean, we published a piece a couple weeks ago saying that, it was pointing out that it was the lowest all-in yield in high yield on record. We got spreads that are back to pre-COVID tight levels and approaching all-time tight levels. There's at the same time, on the other side of that coin, where else are you going to go to get that type of yield if you're a fixed income investor with a limited mandate? And two, there's sort of at least an implicit backstop from the Fed. And so, we own some high yield credit in some of our fixed income strategies where it's appropriate, but we're not in a sort of a massive load the boat type of situation in high yield, just because we don't really think the risk reward is that advantageous. We would rather kind of take some risk in some other parts of the fixed income market, not as directly suppressed in terms of where spreads are by the Fed, things like emerging market bonds or preferred equities, those types of things. And so I think that's sort of how we're thinking about high yield at this point. It's a hold, probably, is, I guess you would say, not necessarily something that you want to be all in on just because there is not a ton of room for error.
Yeah, no, that makes a lot of sense. You just mentioned, and you've mentioned a couple of times throughout the conversation, the emerging market space, both on the equity and debt side. Can you elaborate a little bit more into, maybe on both sides, where you find the opportunity, maybe from a country standpoint, and how you guys are deploying capital, in those two spaces?
Sure. So on the equity side, we've been somewhat kind of neutral to our benchmark on emerging markets for a good bit of last year, especially in the second half of last year. But as we started to get more clarity on the economic outlook, we saw the dollar was weakening, and emerging market currencies had a very large kind of valuation gap versus where they were kind of pre-pandemic or even pre-trade war, frankly. So there's a lot of reasons, kind of tailwinds behind emerging markets. And so we've been kind of increasing our allocations on the equity side there for some time. And we've also been kind of focusing a lot on specific allocations within Asia as well. That's for a couple of reasons. One, if some of it's for portfolio balance, if you're kind of taking more risk on the domestic side of your portfolio within small caps, let's just say, having something that is able to, and the biggest thing that's going to kind of trip up, a small cap company in the rally that we're seeing today is some material sort of headwinds on the reopening, and that's going to be related to COVID. And so, we kind of view some of those allocations to Asia, specifically North Asia, places that were much better able to manage the virus than we here in the United States or Europe was, frankly, as a bit of a hedge against that. And the other reason that we do like that, and I think emerging markets gets a little bit of a misnomer from the kind of the BRIC days in the early 2000s. It's not a bunch of energy companies and financials. That idea of that's what the making, exporting whatever things to the engine that is China, that's building a new city of 20,000 people every month. That's not what emerging markets are anymore. They have a much larger allocation to technology than, say, international developed markets do. They're really kind of moving forward in the ways that the global economy is going. And so, I think that's another reason that we've been comfortable increasing that allocation, pretty substantially over the last couple of months. Mm-hmm. And then on the fixed income side, I think this is just an area of the market that, on a relative kind of spread basis, it's not as controlled by the Fed. There is no 13.3 facility to buy emerging market bonds. So as you kind of push people out the risk spectrum a little bit, that's one that has not really seen the compression and spreads that you have seen in the investment grade and high yield universe. And so, as an appropriately sized kind of position, I think that makes a lot of sense, especially with the kind of the fact that we're starting to see global growth increase, the dollar's on the back foot. That's generally good for emerging market debt dynamics from both the growth side and from the financing condition side. And so those are kind of all reasons that we think that we have a relatively positive outlook on EM at the moment.
How much further, do you see a lot of opportunity on the equity side in particular? How much further do you guys see the opportunity going? Because I know when you look at China and Japan, some of these countries, and specifically in Asia, I mean, they're at all-time highs. And then you look at the technology space. I mean, you have companies that are up a couple 100% through a number of different Asian countries. I mean, do you think this is going to be one of these bull runs that could last a number of years, or when do you guys start thinking about being defensive?
I mean, we're not thinking about it right now. I think there's a lot of, like I said earlier, there's a lot of really, really good reasons to be positive. You've got, upswing in global growth. You've got a Fed that has explicitly said they are going to sit on their hands and not tighten policy and make mistakes like they have in the past to kind of quash an upswing. You've got a lot of sort of excess stimulus that has not been spent that will be deployed, and you've also got specifically on the China front, you've got an administration that, while President Biden by no means is going to cozy back up with China, he's not going to pick a trade war with President Xi over Twitter. And I think just from a business kind of investment and sort of smoothing out a volatility standpoint, that's a big win for both sides, for U.S. companies and for Chinese companies, just to have some stability in terms of, okay, what game are we playing and how can we plan for the future. And so I think we're continuing to look for other opportunities that have better kind of risk reward, as part of our tactical mandates. But right now, those are the ones that we see, looking the best. On that front, I mean, I will say that notably, we obviously kind of believe in this sort of little bit of regime shift in markets, and the fact that we're having an uptick in global growth, and a lot of the things that didn't do very well last year, or maybe the year before that as well, are going to start to do better. I'm noticeably leaving out domestic large cap value in the U.S. Or Europe. Those are two things that got absolutely trashed last year, did really, really poorly. And yes, they did rebound a good bit in the kind of early November, December period of last year, but they still continue to kind of lag the broad market. And that's, I think, really telling to us. We look at the kind of the sector makeup of domestic large cap value. We can't really get excited about financials, given our views on the Fed and that we think interest rates are going to be relatively capped. We can't really get excited about energy, over the medium term, notwithstanding the really ferocious rally it's seen off of the bottom. So, if you're going to get really excited about domestic value, those are the two sectors you have to have a really positive view on, and we just don't have that at this point. And I think similarly about Europe, Europe had a sort of structural growth problem before all of this. They've done maybe better on the public health side, but way worse in terms of the economic output, which, as investors, is what we care about. They've done way worse on the economic front throughout this whole COVID situation. The vaccine rollout is not going well, and they have similar problems in terms of sector makeup of their equity market. And so, there may be a time and a place for those types of things, but we just think the risk reward right now, given where we are in this recovery, is just does not support meaningful allocations to those sectors.
Mm-hmm. Yeah, I mean, do you see any concern, in the European bank space? I know in the past we've had a lot of worries about Spain and Greece, and COVID can't help. Certainly, do you foresee that being a big issue once we get past COVID? In fact, they have to print money to get by.
I mean, maybe not Greece or Southern Europe specifically, but it's really hard. Banks at their core, they borrow short and they lend long. And when interest rates are very low and very flat, it's very, very hard to do your core business. There's some specific situations with the banking sector in places like Germany where it's very, very competitive, that make bank profitability just really, really challenged. And so this has been a persistent situation for the last, since the financial crisis, really. And so, we're a bit skeptical that this is going to be the catalyst to change that.
Yeah, I tend to agree with that. I had two other areas I want to briefly touch on. So ESG has become all over headlines. I mean, and with the Biden administration moving more towards renewable energy and obviously the push towards EV, how are you guys thinking about the ESG space, and how are you guys trying to incorporate it into your framework when picking companies and different funds?
Absolutely. So I think from our perspective, I mean, more than anything, I think we're thinking about ESG as an emerging factor. A factor is just a characteristic of a certain type of stocks that they all share, be that low valuation or, kind of low volatility or a high quality earnings stream or something like that. As we start to see more adoption and make no mistake, there's definitely more adoption of ESG sort of, first in Europe, they were definitely in the vanguard of all of this, but increasingly in the U.S., as we continue to see that, we think that the companies that score highly that will receive, premium valuations by the market, and so I think that's something that we're definitely conscious of when we're looking at, what types of companies are in various sectors and how they score, and on those, and are they liked or disliked by a lot of the popular ESG vehicles. That's definitely something that we're looking at. I mean, that's something we've been, we didn't take that into account 5 years ago, but certainly now it's something that I think to ignore it, you do so at your peril, kind of given the way that trends are going.
Yeah, and I think that's important, right? And today's been really, really helpful. Just articulating some of the key points you guys are looking at, whether it be ESG or the emerging markets and small cap space. So, Zach, definitely want to say thank you for the time today, and I'm sure my viewers will also appreciate it as well. Thank you so much.
Carl, thank you.
I appreciate it.